Hi, my name's Brian Leverage.
My name's Jeffrey Holst, and we want to welcome you to the 4th episode of the Old Fashioned Real Estate Show.
It's good to be here again, Jeff. Good to see you.
Indeed.
Cheers.
If you haven't poured your drink, now's a great time. I'm not supposed to admit this, but it's about 11 o'clock in the morning as we film this, so good morning, good afternoon, good evening, whatever the case may be for you.
It's always 5 o'clock somewhere, though. Just remember that. Today, we wanted to give you just a little bit of cursory information on some of the advantages and disadvantages of different asset classes. And to keep things simplified for those purposes today, we're going to talk about single-family homes, multifamily residential, that is duplexes, triplexes, and quads, apartment buildings, and then we'll lump everything else into commercial.
Sounds good. So commercials like office, retail, industrial, that sort of thing?
That is correct, yes.
Great.
So we'll start with single family. The pros to single family are that it's typically where everybody starts. The cost of entry is the lowest and thus the easiest. It presents the lowest risk profile, typically. Your appreciation is not tied to your rental income. That is, in a rising market like we're in right now, the value of the house tends to appreciate faster than the rental income that it produces. Okay. You have lower tenant turnover. That's another one. You've also got your expenses tend to be lower as well than, say, apartment buildings. Okay. It's the most common asset type. Obviously, single family homes outnumber every other type of real estate structure in the United States.
One other advantage, I think, is that it's also something that's really easy to understand. Right? Most people are familiar with single-family homes. They know what it's like to live in a house. If they don't live in one now, they've probably grown up in one. And, if you live in an apartment, let's say, you don't necessarily understand what it takes to run an apartment complex. But if you live in a house, you know what it takes to run a house. I mean, single-family homes are pretty straightforward.
That is correct. So now, talking about some of the cons or disadvantages of a house, the first is that you have price volatility. So as much as the fact that the rents are not tied to the value of a house, in a declining market, even though your rents are the same, the house can lose its value. That's not good, okay? Your property is either 100% vacant or it's 100% occupied. So it's great when somebody's living there, not so good when they're not, okay? There's no economies of scale either. So if you want to make a lot of money just from your rental income, you got to own a lot of houses. And lastly, your financing on single family homes is almost always recourse, meaning you're personally on the hook for the mortgage if you were to be foreclosed on.
Yeah, I think there's maybe another con that we could throw in there too, which is that if you do have something like a roof or a furnace go out in a single family home, when that happens, it can eliminate all of the cash flow for that property for a year or two or maybe more. If you're making $200 or $300 a month and you have to replace a furnace, that's at least a year worth of your cash flow. So, where if you have to replace a furnace on a multifamily or on a non-residential property or something like that, it usually isn't going to eliminate an entire year's worth of cash flow. Now, you can budget for this stuff, but it is important to know that that's one of the things you have to be watching out for. So,
good point. So, multifamily residential, which is everything 2 units to 4 units, they tend to be more stable than single family homes because you have more tenants in one property than you do, obviously, in a single family. Also, you have greater income potential as a result of that. So typically your cash flow will be higher on one of those properties than versus a single family house. They are valued as much on an income approach. That is, when you buy it, an appraiser will look at it. He'll look at the income that it produces, and that will weigh more heavily in how they value the property versus looking at a comparable sales approach.
But in fairness, they still spend a lot of time looking at comparable sales, and if there are any, especially with duplexes, which there's a few more of than triplexes or quads, they'll look at and say, hey, this duplex down the street, substantially similar, sold for this amount, and they're going to look at that.
Yes.
Where in apartment complexes, that's really not the case at all.
Not as much. No.
I mean, they do look at it some, but I would say this is sort of like a middle ground between the two.
It is. It's a hybrid. So You also, though, you can force appreciation through rent increases or improvements to the property, so that income approach does weigh back in as a result
Certainly.
of that.
And in fairness, though, it does to some degree weigh in on your single families because some investors will look at the income and say, you're getting good rents here, so I can give you a little bit more money.
Yeah.
So it's like a transition, and all of these factors have some influence, but the further you go down this hierarchy, essentially, the more the income matters and the less the comps matter.
That is true. They're also, in my opinion, a little bit easier to finance than single family because of those factors that you just mentioned. Okay. Some of the negatives to them or disadvantages are you have higher turnover. Typically, you have twice as many tenants. They don't stay as long in duplexes or multifamily as they do in single family, typically. Your expenses run higher as a result of that, but also they tend to be assessed differently. Property taxes are higher on multifamily and commercial for that matter than on single family. So you need to account for that in your math as well. Your financing, much like single family, it's also recourse on that. And you have a higher barrier to entry because the cost is usually a little bit more than a single family.
And also, I think the financing might even be a little bit harder in some cases on multifamily because if you're just starting out in real estate with single family, a lot of times you can get into some FHA programs with low down payments, which you can do it in multis, in small multis, but it's more difficult. So you have to, maybe you could move into one side of a duplex and get that kind of FHA, 3.5% or 5% down loans. But typically when you're buying as an investor, you're going to be putting 20%, or in some cases even more than that down. And that makes it more difficult to finance it. You have to have more resources to be able to do it.
Yes. So now we move to apartments, which in my opinion is probably the stablest of all asset classes of residential investment property. Your tenant base is diversified. That is, they work in all different sectors of the economy. So were to something to happen in a slowdown, generally that segment that might be affected, say auto or manufacturing, whatever, really, it doesn't matter, will be offset by those that work in other fields. Your rents also tend to recover faster in a downturn. The last recession, we saw rents recover typically within about 18 months, whereas housing values took years longer than that. Okay, your value is much more highly tied to your net operating income. So the more income the property produces, and more importantly, that's the old-fashioned so early in the morning talking. The more net operating income you keep, the more your property is worth.
Can we sidebar that just for a second? In case people aren't aware of what net operating income is, net operating income, it's sort of self-explanatory. They often call it NOI, but it's the income that you have after all of your operating expenses. But critically, operating expenses do not include your income taxes and they don't include your financing costs. So this is really what, if you paid cash for a property, what your pre-tax income on that property would be after all expenses.
Yes. So they're more predictable, which is a huge advantage because typically it's very easy to see what the market rents are, and you can then tell pretty quickly whether you're getting a good purchase price based off of the rents that it presently has at the time of acquisition.
And in reality, a lot of times seeing what the market rent is just looking at other units in that same building. The owner may not have raised rents on some people that have been there for 4 or 5 or 6 years, but they just rented a similar unit in the same building for $150 a month more. Well, then you're pretty certain that you can, without too much effort, raise that lower rent to the higher amount.
And as a result of that increase, you can create tremendous upside equity through rent appreciation. They also, the demand for housing is constant regardless of the economy. So sometimes rents may fall a little bit, but your occupancies aren't significantly affected, which again just ties back in with them.
And what typically happens when the economy is soft is that apartments are a little bit harder to fill, so your occupancy might be a little bit lower. You might have to give some kind of concessions, or your rents might not go up like they typically do for a year or two. But I agree with you completely. I think that once you have an apartment, it's usually pretty
Yeah.
easy to keep full. So
And last but not least, depending on the loan size, you can get non-recourse financing on apartments, which is something that should never be understated. Because if you're not on the hook for the loan, then your risk on that asset is reduced even further.
yeah, and in fairness, I mean, we could have a whole show on recourse versus non-recourse. And we will at some point. But the critical point with non-recourse is that it's a more advanced strategy. It's not something that if you've never had a rental property, you're going to just be able to go out and buy an apartment non-recourse. Unless you tie in with someone who has experience, or you get a good property management company that the financing institution believes can handle it. Because when they look at non-recourse, what they're looking for is they're really looking to see if the person that's operating it knows what they're doing and if the project itself will support the loan.
The disadvantages to apartments are fewer, in my opinion. There's a higher barrier to entry. That has as much to do with the stability, so the values tend to be fairly static. You know, you can find deals on them at times, yes, but typically they aren't given away. Your expenses also run higher than other residential asset classes. That's primarily due to consistent turnover. So when you get a vacancy, obviously you're going to maybe repaint, clean, etc. And that's money out of that goes into your expense category on your operational side in the long run. So now we'll get to the last one, which is commercial. And there are a lot of benefits to owning commercial properties. First of which is that your lease terms tend to be much longer. Your average residential lease is about 1 year, usually. Okay, with commercial leases, those could be 3, 5, 7 years. Usually there's options to extend beyond the initial term. It's not uncommon to see tenants in place for over 10 or 15 years in some instances. You also have a lot more lease flexibility where the tenant can carry the expense burden. So they might pay their share of the taxes, insurance, in addition to handling their own maintenance. They're stable as well. A lot of times you have large corporations or what we call credit tenants. Credit tenants present lower risk than residential tenants, frankly. Your financing too, again, depending on loan size and experience, as we noted, can also be non-recourse on these. Your expenses tend to be lower as a proportion of the overall revenue because you don't have the same kind of turnover, etc., like you do. They're also more passive, typically, than residential. Any of your
in some cases,
assets.
Completely passive.
Yeah.
With commercial.
Which, depending on your tolerance as an investor, is something you want to consider when you're looking at anything to invest in the first place.
Yeah, and your returns might not be quite as great if you get completely passive. If you get a rent situation where it's triple net, which means that the tenant's paying all the expenses, and all you really have to do is wait for the auto deposit into your bank account, it's really attractive, but the return's probably less than one that you have to do some active management on.
So now some of the disadvantages. The biggest one is that your vacancies, they last a lot longer on average when one comes up. So you have to be prepared for that. Also, your releasing expenses are much greater than with residential. It's not uncommon to have a tenant come in and want to have a space entirely reconfigured. That is, you're moving walls, mechanicals like electrical, plumbing, and heating and air, and redoing all the cosmetics. Sometimes you're going to do that at your own expense, just depending on what those tenants' needs and demands are in any situation. Also, those tenants are more susceptible to the business cycle. So potentially, you may get an unexpected vacancy if we get some headwinds in their particular economic sector. Okay? There's more competition on commercial. You know, you have all sorts of investors that own smaller properties and larger properties, and they're oftentimes competing for the same type of tenants. And there's also shifting trends in desired locations. Right now, what we're seeing, for example, is that high-rise downtown office vacancies are starting to increase there because the cost of operating those buildings are so high, and businesses are shifting further away from the central core in most markets.
Yeah, and I think you're seeing this in the retail also with the Amazon effect, right? So you've got large malls. Right now, as we're filming this, Sears is essentially out of business or about to go out of business, or maybe they'll be saved, but they're closing stores, and they're certainly not the first company to go through that. And when you get these large, vacancies, they can be tricky to fill in today's market where smaller retail seems to be doing pretty well. And so it just, that's sort of a trend that's more recent. And
Yeah.
you're going to continue to see those kinds of trends develop over time.
Absolutely. Well, I hope this segment was informative and gave you a base level of information with which to help identify what might suit you going forward. And we look forward to talking with you again. Enjoy. Cheers.
Thank you.